Hello and welcome to Livewire Markets. I'm Ali Selby, and today we're sitting down for a chat with multi-asset specialist Anthony Golowenko from MLC Asset Management. Thanks so much for joining me, Anthony.
Thanks for having me.
Taking a more macro view now, where do you think we are in the market cycle?
Looking at financial year 21, we've had some cracking results out of equity markets. Many people in reviewing their super balances may have got a very pleasant surprise as to the degree of returns. But stepping back from that on a 2 to 3 year view, what we've really done is just re-establish these intermediate trends. So going back to post-financial crisis, we saw accommodative traditional measures implemented by central banks and cash rates being cut to what were then very low levels. Subsequently, they've gone to effectively zero, in some cases below zero, and that's amplified through unconventional measures through the yield curve. So in this environment, where we've got equities at or near record highs, bond investors and bond yields at or near record lows, central banks continuing with their conventional and unconventional stimulus, all the while we've got fiscal taps turned firmly on. Now, in that environment, all of these forces point directly at the inflationary outlook. But from my perspective and thinking of that environment, look, something's got to give. And whether that's a gradual adjustment in bond yields, whether that's central banks, and we're starting to see that, and we'll hopefully get some guidance as to the program of very sequentially deleveraging, and it's going to be a very closely managed approach. But the strength in equities, the resilience of bonds, even in this environment, and ultimately inflation expectations that are moving. We know the base effects are cycling off beyond the near term. Supply chain, it's going to take beyond the near term, but we see that also as being resolved. This key issue is around the consumer and the consumer demand coming through in both on the couch goods demand and off the couch services. And it's the two of those together with a view of moving towards full employment, where we get to that desired end state of ultimately real wages growth, resilience in the economy, and a gradual unwind of these really accommodative unconventional policy measures. So something's got to give. We believe it does have to give. The path is a very careful one to be undertaken in concert with central banks and fiscal policy. But ultimately, how MLC thinks about positioning our portfolios is elements that are deliberate and are going to play offense, so more participate in continued market strength, and looking at other pieces that are going to be more resilient and more diversified, whether that's derivatives or options on the downside, whether it's a foundation of income through things like real estate or global listed infrastructure, whether that's short dated maturity. We've got a participate and protect mantra, and we're bringing that together really in a market environment where we are, that we're certainly not the start of a new bull market. We're more towards the end of something that's going to be an elongated investment period. We certainly want to deploy capital very judiciously in this environment.
Okay, so what asset classes do you believe have limited upside ahead of them with all that in mind?
Look, I think stepping back from the dynamic that we see in investment markets, and central banks really have just gone out of the gates to stimulate and to continue to stimulate with both conventional and, more importantly, unconventional policy. What's that has done is crushed cash rates. It's then expanded through the yield curve, and we still see across a large proportion of government bonds negative yielding investments. So for our investors, and we think about a medium-term horizon and achieving that, nominal bonds are the obvious area that we want to be deliberate in our exposure. Longer duration exposures we've brought and narrowed down. So that's an area that we don't see the risk reward being or delivering the payoff that we're looking for. And traditionally, fixed interest has played two key roles within a portfolio. And the first of those providing a foundation of regular income, and the second providing diversification in periods of uncertainty and volatility. Where things are in yields being as low and as anemic as they are in traditional nominal bonds, we're not getting that foundation of regular income, and we're also got a significant capital at risk. So what we've done in response is shorten up some of that duration. We've utilized more credit exposure in longer maturities, and we've also brought in inflation-linked exposures. Other areas, and I've mentioned the real estate, and we see in the listed space significant opportunities in those cash flows. One area where we're more limited in our exposure is in traditional big box discretionary retailing. We think there is potential in, or ultimately through vaccines and through science, we are moving to a more opening and reopening of global economies. The challenge and through the period, even before the pandemic, we've seen this business model potentially challenged. Risks are elevated, and we view that our capital can be more efficiently deployed in other areas of real estate and infrastructure.
Are there any areas within equities that you guys are actively avoiding?
Well, equities, there's certainly the challenge, and going into reporting season, we're coming in with some fairly high levels of optimism, and that's sort of playing out in one, the results, two, outlook statements, which not surprisingly, we're not getting a lot, or we're getting quite a reasonable amount of conservatism in outlook statements. And given valuations are as elevated as they are, there's a potential for a fairly amplified or fairly large drawdown should those expectations not be met. So within our program and managers that we utilize, we certainly want to focus on quality. We're prepared in those areas really to pay up for that quality as it manifests and allows time to play out. So we'll tend to focus on not necessarily inexpensive companies, but companies in industrials and high quality industrials that can grow into their valuation, as opposed to maybe some of the more speculative and technology related smaller names. So businesses maybe in the mid-cap space, such as Reliance Worldwide, maybe into that mid to large, businesses such as James Hardie. Traditionally, they are a bit more expensive. We view they have an opportunity to grow into those valuations. But yes, not seeking out or really stretching it in terms of our portfolio positioning.